Time is the friend of the wonderful company, the enemy of the mediocre. Based on this famous quote by Warren Buffett, in this video, I will introduce you to 4 stocks for a buy and hold strategy that have the potential to significantly increase your wealth over time. Let's jump right into the first stock. First, I'd like to introduce you to the company Dynacor. The company is headquartered in Montreal, Canada, and is primarily engaged in gold production with a strong focus on South America, specifically Peru. Here, you'll also find an introductory video that highlights some key aspects: profitability, debt-free status, and dividend payments. Feel free to watch it for more insights. If you scroll down further, you'll find information about the company's history as well as some important objectives. Now, let's take a closer look at some more details. First, I open the maximum chart. Here, we can see that over a period of nearly 15 years, the stock has multiplied, specifically gaining 2,169%. The company was founded in 1996, meaning it has been in the market for almost 30 years, demonstrating a solid history. Beyond that, the financial metrics are also very strong. We see consistent revenue and profit growth from 2020 to 2023. Moving on to the financial statements, we can confirm this solid trend under net income growth, showing steady improvement from 2021 to September 2024, along with strong revenue growth. Now, let's take a look at the valuation of the stock. As of February 2025, we find a price-to-earnings ratio below 10, a price-to-book ratio of 1.4, further an enterprise value-to-EBIT ratio well below 10, and a debt-to-equity ratio close to 0, confirming the company's debt-free status. Finally, looking at the return on equity ratio, we see that in recent years, it has remained in the solid double-digit percentage range. This indicates that the company is utilizing its capital efficiently and generating solid profits. Overall, the stock can be considered as fairly valued based on these metrics. Additionally, we should take into account the crises of recent years, including the COVID-19 pandemic, inflation crisis, energy crisis, and the war in Ukraine. Despite facing multiple challenges, the company has managed to achieve solid revenue and profit growth, which speaks for a resilient business model. Let's also take a look at the development of the gold price. You can see it here in the overview. As you can observe, over a period of nearly 25 years, the gold price has multiplied, increasing by approximately 900%. This strong long-term growth is another argument in favor of a long-term investment in this stock. Finally, let's take a quick look at the future outlook. For this, I've reviewed the September 2024 quarterly report. Here, we can see that the company is operating within its forecast range, with the most important takeaway being that net profit is expected to significantly exceed its own projections. While these figures refer to 2024, they still indicate, especially considering the current gold price level, that the company is on a strong path forward. Next, I'd like to introduce you to the company Sompo, which is headquartered in Tokyo, Japan. Sompo operates in the insurance business. We can take a look at the profile overview here for more details. The company primarily focuses on solutions in property and casualty insurance, overseas insurance, life insurance, and nursing care insurance. The company is structured accordingly, as you can see here on the website, where it also provides some first insights into its current business situation. For example, we can see that the international segment contributes a significant portion of the profits. Further down, we also find the first indications of a very solid financial foundation. Let's also take a closer look at the details. To do this, I'll open the long-term chart again, and we can see that the stock price has more than doubled over a period of about 7 years. The company was founded in 2010, meaning it has now been in the market for nearly 15 years, demonstrating a solid track record. Looking at the financial metrics, we can see that both revenue and profit have steadily increased over time. For more details, I'll go into the financial statements again. Here, we can observe solid revenue growth over the past years, along with consistent profit growth. Additionally, the company has, as of February 2025, attractive valuation metrics. For example, a price-to-earnings ratio below 10, a price-to-book ratio of 1.35, and an enterprise value-to-EBIT ratio below 10. On top of that, it has a debt-to-equity ratio just above 0, indicating low debt levels, as well as a return on equity ratio that has consistently remained in the double-digit percentage range in recent years. This allows us to conclude that we are looking at a fairly valued stock. Here, we also want to take a closer look at the company's future prospects. We can find an overview of its various segments here. I'll scroll down, and as we can quickly see, stable growth is expected to continue. This is a good indicator of a potentially rising stock price in the future. The third company I'd like to introduce to you is the Mori Construct Group, a company specializing in construction solutions. It offers services such as the renovation and restoration of both public and private buildings. Mori Construct is a Belgian, family-run company that has grown over the years to become one of the leading providers in this sector. Let's take a closer look at the details. I'll open the long-term chart as usual, and as we can see, the stock price has risen by approximately 600% over the past 25 years. The company was founded in 1920, giving it a long history, and its financial metrics are also impressive. From 2019 to 2023, both revenue and profits steadily increased. Now, let's examine the financial metrics in more detail. Over the past years, we can see clear and healthy revenue growth, along with strong profit growth that has consistently remained in the double-digit percentage range. Next, let's look at the stock's valuation. As of February 2025, we see a price-to-earnings ratio of 7.3, a price-to-book ratio of 1.68, an enterprise value-to-EBIT ratio of 2.74, and a debt-to-equity ratio close to 0, meaning the company is virtually debt-free. Additionally, it has a return on equity ratio consistently above 20% since 2021, indicating that the company utilizes its capital very efficiently and profitably. This also allows us to speak of a resilient business model, especially when considering the crises of recent years. Despite these challenges, the company has managed to increase both revenue and profit even in difficult market conditions. The current dividend yield of just over 2% further complements the solid overall picture. Let's also take a look at the company's outlook. I've taken this information from the half-year report as of June 2024. While the report is in French, the key message is that the company has a record order backlog of 335 million euros. The group is financially very solid, and construction activities are progressing as planned. Additionally, you should mark your calendars, as the 2024 annual report will be released on March 18th. This report will likely provide further insights into the company's outlook for 2025. The next company I'd like to introduce to you is BP Marsh & Partners. This investment firm specializes in early-stage investments in young financial service providers, helping them build and expand their business models. Initial investments can go up to £5 million, with a focus on long-term partnerships to create the most valuable and sustainable exits. The company has already invested in over 50 businesses and has a track record spanning nearly 30 years. Let's take another look at the details. I've selected the long-term chart again, and as we can see, the stock has risen by around 350% over the past 18 years. This aligns with a strong financial performance, which we can observe here. From 2019 to 2023, both revenue and profit have shown consistent growth. Looking at the financial statements, we can see even more details, a solid revenue increase over the past years, along with steady profit growth. Looking again at the stock's valuation as of February 2025, we find a price-to-earnings ratio of 4.63, a price-to-book ratio of exactly 1, and an enterprise value-to-EBIT ratio of 2.94. Additionally, the debt-to-equity ratio stands at 0, indicating a debt-free business. Furthermore, the return on equity ROE ratio has consistently been in the solid double-digit percentage range over the past years. Once again, based on the revenue and profit growth of recent years, we can consider this a fairly valued stock. Additionally, we see a resilient business model that has navigated past crises very well. The current dividend yield of just over 2% further complements the positive overall picture. Here, we take another look at the company's future prospects. For this, I have reviewed the 2024 half-year report. In the section shown here, it is stated that the company is financially very solid and has been able to adapt well to challenging market conditions. This means it is well positioned to seize further investment opportunities. An additional insight comes from the Chief Investment Officer's update in the final section, which highlights that market consolidation in the insurance sector shows no signs of slowing down in 2024. This ongoing trend could serve as a catalyst for strong future opportunities. To conclude this video, let's summarize the key takeaways you should apply when selecting stocks for a buy and hold strategy. First, you should focus on the business model. Make sure you understand how the company operates and how it generates profits. Additionally, ensure that the business model is resilient and has a competitive moat. A good way to assess this is by looking at the past 5 years to see how well the company has navigated through various crises. Point 2. Company history. You need to ensure that the company has been operating in the market for at least a few years, ideally for decades. Over its history, the company should demonstrate consistent long-term revenue and profit growth. Point 3. Company leadership. The management team should have demonstrated its competence, especially during past crises. Additionally, management should always keep shareholder interests in mind. You can assess this by looking at regular dividend increases, share buyback programs, and how efficiently the company utilizes its financial resources to generate further profits. Ideally, the company should be managed with minimal or no debt. Next, you should analyze the company's future prospects. Check how management assesses the coming months and years, whether the company's products and services have strong potential for increasing demand, and consider market opinions as well. Alongside a strong long-term profit history, this is one of the most crucial factors to evaluate. Finally, take a quick look at the technical chart analysis. Has the stock price consistently followed the company's fundamentals over time? In the long run, the stock market typically reflects a company's fundamental performance. While past performance doesn't guarantee future results, you should still observe a positive long-term chart trend for any company you consider investing in. Additionally, assess the stock's current valuation. Use the fundamental metrics shown in this video, such as the price-to-earnings ratio and the price-to-book ratio, to determine whether the stock is fairly valued. That brings us to the end of this video. I hope I was able to introduce you to 4 interesting stock ideas for a buy and hold strategy and show you how to identify such stocks, learn from the best, invest with a long-term perspective and patience, and you will be richly rewarded over time. Wishing you success in building your wealth. And I hope to see you again in the next video.